Welcome to Bot City. I'm Jet West, broadcasting from the 43rd floor in Tokyo. Today, we're pulling apart one of the strangest financial stories of the year. A 28-year-old AGI true believer who lost 2/3 of his fund in a single month and is still beating almost everyone on Wall Street. And the way his portfolio blew up and then bounced tells you something important about the AI infrastructure trade that most of the coverage completely missed. Leopold Aschenbrenner's fund lost 67% in July and is still up 80% for the year. Read that again. He detonated. He also had one of the best years on Wall Street. Both of those are true at the same time. And the day his bankers forced him to sell everything, SanDisk and Bloom Energy jumped more than 20% in a session, and every other AI hedge fund in the world quietly exhaled. So which story do you want? Because there are two, and they do not agree. The wire copy will tell you the S&P popped 1.7% on the 30th, NASDAQ up 2.8%, and it was all thanks to Microsoft earnings. Strong quarter, relief rally, the machine works, clean, corporate. The kind of explanation you can put in a headline without anyone asking a follow-up. Then there's the other version, the one reported by Business Insider, where the actual mechanical trigger was a 28-year-old ex-OpenAI researcher getting margin called into the pavement, and his distressed book getting bought out from under Millennium and Jane Street by Citadel. Ken Griffin outbidding the room for the wreckage. That is not an earnings story. That is a liquidation. And it moved the entire tape. And here's the detail that tells you which version is real. Even after that 20% pop, SanDisk was still sitting about 45% below where it started the month. Bloom Energy still down around 30%. If Microsoft earnings had genuinely healed the AI trade, you would not have a 45% shaped hole in the recovery. Relief rallies closed the gap. This one barely scratched it. Nothing says we're back like recovering a fifth of your losses and calling it a comeback. Let me back up, because the fund is the receipt, not the story. The story is what the fund reveals. Aschenbrenner is not a nobody who got unlucky. He's the guy who wrote the situational awareness essay, the AGI manifesto, the one that argued we were sprinting toward a national security scale compute build-out and everyone should position accordingly. He took that thesis and built a fund on it, concentrated, leveraged, betting on the picks and shovels layer under the models, not OpenAI, not Anthropic, the memory chips, the power, the cloud compute, the foundries, SK Hynix, Kioxia, SanDisk, Bloom Energy, CoreWeave, TSMC, the stuff you need to actually run the future he was so certain was coming. And here's the part nobody's saying out loud. He wasn't alone in that trade. He was in the identical trade as everyone else. Whale Rock, $19 billion, up 70% in the first half, long the exact same names. The Tiger Cubs, Cotu, Tiger Global, Maverick, Light Street, Atreides, Altimeter, all crowded into TSMC and CoreWeave and Lam Research. Over in Asia, the WT China Fund was up 120% in the first half, then gave back 17%. Keystone, up 63%, then down 12%. Same wound, different letterhead. Bank of America's fund manager survey had flagged it in advance. Global semiconductors, the single most crowded trade on the street. Everybody standing on the same side of the same boat, congratulating each other on the view. Now watch the mechanism, because this is the part that's genuinely precise and genuinely underreported. The global banks, the prime brokers, had started rationing swap financing on names like SK Hynix and Samsung, raising rates on the leveraged bets, quietly pulling back the amount of borrowed money you could point at these positions. That is not a crash. That is a decision, a deliberate de-risking by the people who lend the leverage. And when you tighten financing on a crowded, leveraged, identical book, you don't get a wobble. You get a cascade. The weakest capitalized holder gets a margin call, has to sell. The selling drops the price. The lower price triggers the next margin call, and around it goes until somebody's whole portfolio has to change hands at once. That somebody was situational awareness. The AGI true believer liquidated on the AI trade. There is a version of this that a novelist would have been too heavy-handed to write. SK Hynix, down about 28% on the month. Kioxia, down 28% and now sitting 40% off its peak. These are not meme stocks. These are the physical substrate of the entire AI story. And they moved like penny stocks because the positioning above them was that fragile. So the AI CapEx thesis met its first real liquidity stress test. Years of chip and energy and cooling demand, all priced in, all levered up. And the answer the market gave back was, one margin call moves the whole thing, both directions. Down when he was bleeding, up when Citadel absorbed the corpse. Which brings me to what nobody in this coverage is actually asking. If every major tech fund held these same names and one forced seller could swing the tape this hard in both directions, what happens when the next one goes? Because the crowding didn't disappear on the 30th. Citadel buying the book doesn't uncrowd the trade. It just moved the leverage into stronger hands for a minute. The BI piece lists all these funds, Whale Rock and Cotu and the rest, but it treats the crowding like set dressing. Color. It's not color. It's the risk. It's the whole risk. And the fundamental question, the one that actually matters, shows up exactly once, buried in a single quote from a portfolio manager at DWS, Tobias Rommel. He says the AI story in semiconductors remains intact, but after the rally, it's less about growth and more about the sustainability of earnings. Read that slowly, because it's the only honest sentence in the entire file. He's not saying the thesis is broken. He's saying the easy part is over. From here, these companies have to earn the margins already baked into their price. That is a completely different game than AGI is coming, buy everything with silicon in it. DWS downgraded the whole global semiconductor industry from positive to neutral. Not a panic, a shrug. The most damning thing a bank can do to a story is stop being excited about it. There's one more thread the coverage drops on the floor. This whole sell-off was reportedly nerves ahead of the hyperscaler CapEx numbers. Microsoft, Meta, Amazon, everyone waiting to see if the companies actually spending the money would keep spending it. And then the rebound gets credited to Microsoft earnings, but the actual CapEx figures, the numbers that would either confirm the thesis or kill it, never make it into the story. We got the relief. We didn't get the receipts for the relief, which is convenient if the relief was really just Citadel buying a fire sale. One quiet corporate note before I land this. Watch how the funds talk about it. John Pinkel at Indus, and I'll give him credit, he said it plainly. The July sell-off reflected fund positioning more than stock fundamentals. Managers without enough cash on hand became forced sellers and amplified the pullback. That's the truest thing anyone said on the record. Positioning, not fundamentals. The trade broke. The thesis didn't necessarily break. Those are not the same sentence, and most of the coverage smeared them together into one comfortable word: rebound. So should the whole market send Leopold Aschenbrenner a thank you note? Kind of, yeah. His fund losing 2/3 of its value in a month is the thing that generated the forced buying that lifted everybody else's screens green on the 30th. His pain was their relief rally. And the cruelest math in the whole story is that his 67% July was a rounding error against his own 80% year. The man who got liquidated is still beating almost everyone who's celebrating. The rebound wasn't a recovery. It was a portfolio changing hands. The AI infrastructure trade is still the most crowded bet on Wall Street, still levered, still identical across every fund that matters, and the banks have already shown they'll pull the financing when they get nervous. One margin call did all of this. There are a lot more funds standing on that same boat, admiring the same view, and the water just told them exactly how deep it is. Thanks for riding this one out with me. Buy City drops every day. I'm Jet West, and I'll see you tomorrow.
Grab news. Thomas.